Hello, everyone. Thank you for joining us today during your pre-lunch break to talk about all things funding. I'm Lauren Coffey. I'm the person behind Tampa Bay Inno, and this is our first ever virtual State of Innovation event. So thank you so much for being here. We're going to dive right in, but first we want to give a big shout out to our sponsors who made this possible: Synapse, University of Tampa, and Omni Public. Thank you guys for helping facilitate these kinds of conversations. So just a little bit before why we're here and what we're doing. I'm Lauren, like I said, and I am with Tampa Bay Inno, which covers tech and early stage startups and also later stage startups and the Tampa Bay ecosystem. Everything from funding to new presidents, new expansion, just kind of run the gamut. And then we do things like have our stories on our website at tampabayinno.com. We also do events like this where we go into a deeper industry or topic that you guys are obviously curious about. And just to make sure you don't miss any of the updates from anything at all, make sure to go to tampabayinno.com and sign up for the newsletter. It comes to your inbox twice a week on Tuesdays and Thursdays, and it's free and full of information like this. So we're going to dive right into it. I'll let everyone introduce themselves. We kind of ran the gamut between having super early stage startup funders and then the later stage to the $2 to $10 million range. So I think between everyone, if you have a question, you can get it answered. And if you do want to ask a question, there is a little thing on the side that says questions, and you can just submit it there. And then we'll go through those at the end of the discussion. So we'll start with Kathy. She's all the way from Orlando, which is a nice little benefit of these virtual events to have people outside of our typical region. So Kathy, you can kick us off.
Hi, I'm Kathy Chiu. I'm a managing partner at DeepWork Capital. So we are located in Orlando, as Lauren said, and we do early stage venture capital funds kind of investments. And we invest typically in seed round or Series A round.
Great. Dave, do you want to go next?
Sure, I'm Dave Chitester. I'm the founder of Seedfunders. I'm also the founder of Florida Funders, but a few years ago I turned it over to some very competent people to run it, like Saxon and Mark and Tom, and retired for a little while and then unretired and started Seedfunders 3 years ago or so. We launched 2.5 years ago, and we invest in early, really early, like pre-revenue companies. We look for, my one-liner is pre-revenue scalable technology with a clean cap table. So we want to be the first professional investors on board after the friends and family round and help the company succeed, get them that first $150,000, our average is $150,000, get them to the level where they're fundable by these other people on the call here, where they can move up stage and get additional funding. So we invest, like I said, average about $150,000. We are headquartered in St. Petersburg. Our original outlet is St. Petersburg, our office. We have recently started Seedfunders Orlando about a year ago. Dennis Poppy is our CEO in Orlando. And last month we launched Seedfunders Miami as well. So we are throughout the state. We're state only, Florida only. Pre-revenue technology companies is our target.
Perfect. And speaking of Florida funders, we'll pass it off to Saxon.
Yeah, absolutely, and great to be here today, Lauren and the team. Thank you all so much. My name is Saxon Baum, and I'm the VP of Investor Relations at Florida Funders. Florida Funders is an early stage venture firm. We have a unique model where we're a hybrid between a venture capital fund and an angel investor network. So we invest in really seed through Series A, but primarily we focus on Series A and pre-Series A investments. We only invest in companies that have some sort of impact on the state of Florida. So for us, it's all about creating Florida known for tech and innovation, not just tourism and strawberries, as Tom Wallace always says. So that's a little bit about me and Florida Fund.
Perfect. And Barry, you can round us out.
Thanks, Lauren. So I'm Barry Shevlin. I'm a senior managing director at Skyway Capital Markets here in Tampa. Skyway is a 20-year-old investment bank that has historically been focused on helping lower mid-market companies either raise growth capital or sell their business when that becomes time. They kind of loosely define that as lower mid-market as organizations with like $2 to $10 million in EBITDA. So a little later stage than stuff that Dave and Saxon would be working on. It gives us slightly different view of the kind of the capital markets. I joined the firm about 4 months ago to lead a technology practice. So my focus is doing executing Skyway's vision for technology companies, typically founder-owned companies looking to raise growth capital or potentially sell their business.
Perfect. I'm so excited everyone's here. You guys are kind of the cream of the crop, and so I think we'll get some really good information out of this. But let's just start from the beginning, March, which feels like a million years ago. When did this all kind of happen for you guys? When you heard about coronavirus, when did you switch to remote? And what was that process like? Was it kind of a bumpy process in a world where it's like so important to have one-on-one conversations and the handshakes and the lunches, or was it more seamless than you thought? So anyone can start.
Well, I'll start. We meet every Monday at 10 o'clock, pre-COVID. We met downtown St. Petersburg every Monday at 10 o'clock. We would get 10 to 15 partners that would attend the meetings. March 12th, when everything shut down, we immediately went to online Zoom meetings. We still meet every Monday at 10 o'clock by Zoom. The best thing is we can now bring in all of our partners who travel, who are in Orlando, who are in Miami. And we now get 25 partners at Zoom meetings every Monday morning. And so we see deals, we see the actual presentations via Zoom, and we haven't missed a beat.
Good to hear.
Prior to joining Skyway, I was the founder and CEO of Vology. I was still actually there in March. I transitioned to Skyway in April. So when this hit, fortunately, over the last 2 years, Vology had really taken a cloud-first approach to their internal infrastructure, and they were able to, in a matter of a week, have everyone working remotely, and it was pretty seamless. I'd say it was pretty impressive actually that they were able to deploy everyone to their home offices, and supporting the customers really didn't miss a beat. It was impressive.
Yeah, for us, it was right about 3:15. So on 3:15, we had decided that we were going to go fully remote. And we also decided on 3:15 that we were going to take a 30-day pause on any new checks to reevaluate the situation to see what was going to happen over that 30-day period, which looking back was a very smart thing for us to do so that we really could understand, or at least have a little bit of visibility into what the future was going to look like. Obviously, nobody still knows that at this point, but that's what we decided to do. And for us, we're always sort of a cloud-based team. Everything that we do was already had Zoom set up, had Google Drive set up. So for us going fully remote, it wasn't that big of an issue. One of the interesting things was, and this is something that Tom Wallace, the managing partner, and I had sort of a hypothesis around, was that we didn't believe that investors were still going to invest throughout this period. We were extremely scared that we thought the capital was going to dry up. And really, it's been quite the opposite. This past quarter was one of the best quarters that we've ever had from a fundraising standpoint, and I'll sort of get into that later. But the complete change of rhetoric from the investor being able to take everything online instead of that face-to-face has been something that has proven to be very successful for us.
Interesting.
I would say that for us, same as everybody else, that whole March timeframe, there's probably about a 2-week period where we did nothing but to check in with portfolio companies and any of them that needed any sort of help. We've done that in terms of their financing, what to do about the loans and all those conversations. I am surprised at the pipeline, because for a while I thought the pipeline will kind of stall, just because even the entrepreneurs start thinking, well, what's my story now? Mostly by April, though, it came back with a vengeance. We're now probably busier than ever. And because everything is done now remote, a lot of the, I guess, limitations that used to be there actually got removed. So I would say, if anything, we're busier than ever.
Limitations of like meeting in person and just scheduling up time to meet people.
So also you removed a lot of the logistical limitations, the things that really shouldn't be there in the first place. But now, I would just say, when you're dealing with whether investors or sometimes the more experienced entrepreneurs, occasionally they would have a resistance towards teleconferencing necessarily. They wanted to meet in person, and now because that wasn't a choice, they no longer shoot for that. And so you meet faster and you move things along faster.
Yeah, definitely. And I know Kathy and Saxon, you touched on this a bit. Barry and Dave, have you seen a kind of ramp up in your investments right now, or what is your tactic?
We are, as everyone else I think has said here, we're busier than ever. Our investments, we've made we'll close our 8th investment this week since COVID in 4 months. So we're doing 2 a month, and our average is $150,000. Those include 6 new investments and 2 follow-ons from previous investments. And we've invested over $1 million in that period of time in the last 4 months. Our average investment over the last 2.5 years is $150,000, and we've done pretty much the same, and we've actually accelerated our investments through COVID. And I think for a lot of the same reasons Kathy says, it's a lot easier to get entrepreneurs to show up at 10 o'clock Monday on Zoom and to drive halfway across the state and say, well, I can't make it for 2 weeks. And so we have not had a problem with making deals. I will say in the immediate future, I see some deal flow slowing down. We have not recently got a lot of investable deals. We still get a lot of deals, but some of the deal flow has slowed down, at least in the pre-seed or the seed stage that we invest in. I have seen some slowdown, but we do have some quality deals, and we are continuing to invest.
Okay, that's exciting to hear. Barry, do you have something to add?
Yeah, I mean, we're not a direct fund, so we're an intermediary, but we definitely saw things, really grind to a halt at the end of March, and then didn't really see activity pick up again until mid-May. But I would say by June, things were busier than ever. I mean, my assumption is that most of the folks that, if they have a portfolio of businesses, they had to first figure out which ones are going to need help and which ones aren't, and then the ones that needed help, what they were going to do there before they were going to look at new deal flow. But now that that's sorted out and their companies have their COVID plans and they're executing against it, things seem to be, I'd say, back to normal.
As much as it can be during this time.
Right.
I know there's been a lot of acceleration with investment. Has the total amount of capital you plan to deploy in 2020, has that increased, decreased, stayed the same?
I can speak for funders here. So for us, we have not really diverted from our plan. Similar to what Barry said, we took a pretty strong stance to look at our current portfolio throughout that 30-day pause and understand the cash needs of those companies. We understood that companies were not going to be able to hit their projections, and we knew that there was going to need to be capital injections to some companies, not all of the portfolio, but to some of them. And it was especially exciting because there were some companies that have been performing extremely well. Their revenue numbers have been great, and this was just sort of a setback for them. So for us, we did this full, analyzed our whole portfolio, understood what money we needed to keep in reserves, wrote some of those checks, but also didn't really divert much from our plan in terms of the companies that we were already going to be investing in. And what we did was we looked at those companies and we ran another analysis to say, how are they doing since when we first started looking at them, call it beginning of 2020 through maybe the end of March or the middle of April. And what does that look like? How have they been able to perform? What's their plan look like? And really it was interesting because we had 5 companies that we had term sheets out, and all 5 of those companies had continued to perform fairly well throughout the process. And I think that's in nature of the types of investments that we make, being a lot of software-based business to business type investments. But for us, we haven't diverted much in the sense of anything in terms of dollars.
Yeah, we're a little different at Seedfunders. We don't have a fund, so we look at a deal by deal basis. So our investment plans are contingent upon finding the right deals to make the investments in. So we don't have any plan on slowing down, but we don't have a target. We don't have it. It's basically on a deal by deal basis. I will say there's a recent study done by Crunchbase that I just saw actually that compares deals done in the seed. Now this is seed and angel stage only, which is pre the other panelists here, but seed and angel investments compared second quarter of last year to the second quarter of this year. The second quarter of this year obviously just ended 2 weeks ago, and they showed 1,773 deals that were done last year and only 699 this year. So more than 1,000 less deals done now. But the average investment in the last quarter, or the quarter last year, 1.7 billion. That amounts to just under $1 million per deal. What the statistics show now, they invested 1.1 billion, which is $1.6 million per deal. So the $1 million from last year is now $1.6 million for those who are getting deals. It tells me two things. One is that the investors are being more particular about what they invest in the seed stage and angel investment stage. So they're being more particular, but they're putting more money in, which tells me one thing: the valuations have got to be lower. Because, if I take Seedfunders, for example, we have 46 partners. If we put a deal up and people think the valuation is too high, it's a whole lot harder to raise money. If it's a decent valuation, we could raise more money. The better the valuation, the more funds. So the fact that they're raising a whole lot more funds now than they were a year ago tells me that the valuations must be much more reasonable for investors to participate.
Yeah, and I do want to get into valuation later. But Kathy or Barry, do you have anything on this question where it's, have your plans in 2020 changed basically for the amount that you're planning to deploy?
Yeah, well, I'll answer it slightly different this way. I'll say that it was more that in our consideration, and whether or not this is existing companies that we were reserved for, or even new companies as we're looking at it and considering whether or not it's a deal we will get into. We think a lot more about the follow-on funding situation, because whereas before a company that we might be more confident about being able to raise follow-on funds, now we're thinking, well, it's more likely to come from insiders and we need to be prepared for it. And also I need to know that around the table, people are capable of doing it.
Okay, great. Has the industries that you're focusing on changed at all since coronavirus started? Obviously there's no coronavirus proof industry, but there are ones that have kind of come out on top since this all happened, like telehealth and ed tech. Or are you kind of just, since you guys are all technology focused, are you staying the course with just tech in general?
I'll jump in. I mean, we're actually working on a telehealth deal right now. I mean, that is certainly going to be viewed a lot better this year than it would have a year ago. They're coming out of the first 6 months of the year with their best results ever as a business, and we think it's going to be a nice result for the for the ownership group there. So certainly looking at and talking to more folks in that space, and and we continue to I continue to look at folks that are in large scale cloud migrations, and I think a few industries, telehealth being one of them, have become kind of mainstream, but also I think folks plans to migrate their infrastructure from on-prem to the cloud is a trend that's going to continue to accelerate. It already had a tailwind, but now even more so. So I think I'm very focused on that space as well.
Yeah, we once again, we do focus on a lot of software. So that piece, as we know, based on the public markets and private markets, has been pretty steady, if not growing fairly rapidly throughout all this. But really, our deal team led by Ryan Whittemore, his team has done an excellent job throughout this process, really trying to not as much identify new industries, but identify inside of industries which companies haven't been significantly affected throughout this. And really, that's what we've seen is we've now seen what we believe is some of the worst in terms of revenue drops, customer drops. Well, what are those companies that have continued to do well throughout this? And that's really where Ryan and his team are spending time. We had a collaboration software out of Toronto called Vizetto that we invested in. I will say this was good timing by us, but this was not an investment we made during coronavirus. We actually invested in this company several months before, about 2 months before everything happened, but it was just really good timing for us around that. And the other piece that's been really interesting for us and our partners, Mark Blumenthal and Tom Wallace, both have extensive backgrounds in, is education technology. We believe that K through 12 is going to be absolutely flipped on its head. We think that the opportunities inside of K through 12 are just tremendous right now. So we're deeply looking at some of those opportunities. And then the other piece is retail. And I don't mean going into a store, but I mean, what does the future of retail look like? We've had two investments that we've made as of recent. One is coming up here out of Austin, Texas, called Stylus. We're super excited. And essentially, they're trying to take the store and put it on the phone, take the store and bring it to you. And how does that work? So that's sort of where we've been, looking at the forefront of what everything's happening on the coronavirus side of deal flow.
Very cool. I hadn't heard the retail one yet. That's exciting stuff. Dave or Kathy, anything to add?
So I think for us, a lot of the thinking revolves around is the company addressing a need versus is the company addressing a want. And so during the whole coronavirus episode, I think a lot of the want is put on hold, but the need continues. So as we look at a company, that's how we evaluate it. And when you think about it from a more kind of an industry perspective, I would say things like life sciences tend to have a lot of want. And so they march forward and really are less impacted, other than the fact that some of those who got into clinicals may now have a delay. And when companies like that have a delay, because they have such an incredible burn rate, you need to budget for that. But other than that, things don't change very much. People that are selling into enterprises, that's where the need and the want becomes a big differentiator. And it's not like the entire industry changed, but the differentiator on who would make it would definitely change based on coronavirus situation.
Definitely, that's a good point.
I would say that I've noticed from our partners a really, really hesitant to consider anything that's dealing with travel right now. We're open for anything, technology, travel technology, we're open for anything, but we've had a few presentations lately on travel related, and I don't see a lot of interest right now in investing in travel. I agree with what Saxon says about ed tech, med tech. We're into anything like that, but travel seems to be the one industry right now that we'll know it's going to recover. It's just how long, and are we going to invest now, and then money's going to be gone by the time it recovers. So we see a real hesitancy to invest in any travel related technology right now.
Yeah, same with hospitality. I saw that it's tough for them right now because it is so much up in the air. And that's a good point where you can invest now, but the money may be out by the time it actually does recover. So things to consider for sure. But what can companies or startups be doing right now if they are seeking funding? Should they be right now and coming to you guys, or what's a way to stand out when so many people do need money?
At seed stage, obviously, we're investing. www.seedfunders.com. Go online and submit your information, and we look at it. We look at every deal. I respond personally to every single submittal and ask some questions and ask them, if they don't meet our criteria, I tell them why. So I personally respond to every single submittal. So absolutely, go online and we would like to see the seed stage, pre-revenue, early revenue is okay, pre-revenue technology companies.
Okay. Anyone else? Things they can do to stand out? Should they be asking for money right now?
For us, the answer is absolutely yes. I mean, we are deploying capital. We're looking at companies. I think sort of going back to what I said earlier is, can a company show continued traction throughout this? If a company can show continued traction and can show success throughout this, I'm confident that this company can be successful throughout a lot of major issues, because right now is an environment that's extremely tough to run a business in. And if these founders and teams can get through this, I truly believe that they can get through a lot. So for us, it's showing traction, it's showing continued growth, and honestly, some exciting stuff is showing pivot. We've had some companies that have had to pivot a little bit to get to a point where now they're able to generate revenue on a different SKU that they maybe weren't even thinking about before. And it doesn't need to be a full 180. We're seeing pivots, just small little things, tweaking product offerings that have just really helped companies stay afloat. And so, we've even seen some of our SaaS-based companies add a services component just to keep revenue up throughout this whole period. So we're all about founders, we're all about teams, and if they can show tenacity and they can show that they're in it to win it throughout all of this and they're continuing to do well, we would absolutely love to speak with them.
Good, very promising stuff. Kathy, do you have anything to add to that?
Sure. To stand out today is no different than standing out at any other time. You know, if you can show a true plan that is believable plan to succeed, then that's how you stand out. The only difference is now the world has changed. So one thing we always say about founders that stands out is people who truly understand the context in which they operate in. So, you know, you can have all these plans, but, you know, you need to be someone who truly understands the world around you and how that interacts with your entity. And just be sure that your assumptions are still updated, because now it's different.
Good point. I know we touched on valuation a little bit earlier, and I want to start with Barry this time. How has valuations changed during coronavirus? Have you seen companies get lower ones, higher ones? Should companies be considering an exit right now? Or should they kind of wait off until things are a little more stable?
No, I think the timing is still okay now. You know, again, after the pause, things seem to get back to normal in June and July. While we haven't seen a significant change in valuations, we have seen a little more reluctance from the banks from a leverage perspective. So, you know, the deals that are requiring a lot of leverage, or, you know, there's going to be a little bit less debt available, you know, to fund those deals. So that may affect price, it may affect structure, but you know, it's by structure meaning maybe there's more of an earn-out component, seller note, or you know, or the buyer has to put more equity in, but haven't seen a significant change in valuations.
Okay. Anyone else have anything to add about that, or what you've seen?
I think everybody across venture capital has sort of seen a decrease in valuation. Going into 2020, venture capital was at an all-time high in terms of dollars invested, dollars in the market, and we were seeing some very frothy valuations. So I believe that the valuations now are a bit less. Are we seeing a 50% decrease? Absolutely not. But we are seeing what we believe as institutional investors, a bit of a more realistic expectation in terms of valuation, rather than what we were seeing end of 19, early 20. So we are seeing a bit of a drop, but by no means is it at a discounted rate currently, unless, to Dave's point, you're in an industry that really is struggling, like travel, like hospitality, where if you're in those industries right now, it's tough. It's a tough go, and they need to figure out a way to get money as soon as possible. The one thing that we are seeing is very innovative ways of funding. So we're seeing venture debt put on some companies. We're seeing high interest loans. We're seeing high liquidation preferences, sort of in the rescue scenario, coming in with some companies. So that's been something that has changed a little bit. But for us, that's just opportunity for investors to really get the best deal possible.
Yeah, is it more beneficial for the investors right now than the companies versus a year ago? Obviously, the companies had the upper hand.
I wouldn't say that by any means, but I think the playing field has leveled a little bit more in terms of coming back to reality with a lot of the companies and valuations that we're seeing.
Gotcha. Okay. Cool. What has been a challenge that your company has seen during this time, or even that you've been hearing from a lot of your clients that they've seen? I know it's kind of two different things, but have there been any major challenges that have stood out to you?
So I guess I'll answer that question. Obviously, the major challenges right now is there are a lot of things that they can't control. So earlier I had talked about, you know, for life sciences companies, sometimes the clinical situation is very much dependent on when things can start based on the COVID restrictions. There are also a lot of kind of political, geopolitical situations that people have to worry about if they happen to be doing business in those realms. I would say that there are also things to do with what's going on in the public markets. So if you look at some of our startups are funded not just by us funds and angel investors, but sometimes they're funded by institutions that may have exposure to the public markets. And when it's up, it's a thing, and when it's down, it's a thing. You know, let's say even if they are not damaged, when the public market is having a crash, they're going to think, oh my gosh, it's hard for me to make any kind of return that beats this, and this is liquid. So all these things are really outside of an entrepreneur's control. So I would just say that to navigate all these challenges, people who can truly believe in this whole cash is king kind of a concept and navigate towards that is going to come out a winner.
Good
I'd
advice.
say the biggest challenge that I've seen, and I've heard this like 3 times in the last 2 days, is we're not sure what to do with our employees. Half our employees want to come back to work, because they want to be in an office environment. Half of our employees want to stay home. And the CEOs I'm talking to are struggling with that decision. They want to do what's right. They want to be, they want to make sure that people are safe. But I think there's a lot of conflict in that decision. So that's a pretty common theme as people are coming up with get back to the office plans. It's it's wrestling with that decision.
Yeah. What are you advising them for that? Just do what's best for your company?
Yeah, I can't. Yeah.
It's a very individual choice.
It's very situation specific, and I think I'm not going to be doling out advice as it relates to that.
Probably smart. Okay, Dave or Saxon, any difficulties or challenges you've seen?
I agree with Kathy.
Good, succinct. Saxon?
Yeah, I agree with sort of everything that's been said. I think Barry makes a great point here is the personnel challenges. And I think that goes all the way from when this first hit, what does the first wave of potential layoffs look like? What does the furlough look like? What does the PPP look like? How does that affect everything? And then to Barry's point, when are people going back in the office? It's such a situational thing right now. If you're in Florida, it's a lot different than if you're in New York right now. And that was vice versa 3 months ago. So the personnel piece, I think, is definitely hard. And then the other piece that we have seen is sort of the hiring and recruiting process. Since everything is done digitally, which, as we talked about, it's going fairly well for Florida Funders and the rest of the panelists here and their organizations. But there's a qualitative side of hiring that we all know plays a massive factor into making the right hire. And it's hard to get that qualitative feel unless you're actually meeting somebody. So I think that the hiring and scaling side of everything has been a little bit of a challenge for some of these companies that we've invested in. The companies that are sitting on a lot of cash have made some very smart decisions and are basically holding money. They're slowing down growth a little bit to get to the point of when they feel comfortable, they can go out and they can make the decisions that they need, and they'll have the capital to be able to back that up. So those companies that are sitting on a nice cash pile, they're going to be in a great position moving forward after all of this sort of passes and we have some visibility.
Great. All right, one of the last questions from me anyway. Dave, I want to talk to you a little bit about Seedfunders' recently launched Opportunity Fund. For those who didn't know, Seedfunders launched an Opportunity Fund that focused on elevating minority-led startups and making sure that they get basically the attention that they deserve. Dave, was that a process that was happening before kind of the outcries after the George Floyd situation, or was that in response to?
It was in response to. We definitely, my partner Irv Cohen sent me a couple emails, a couple articles the last weekend of May saying, look at all this, we need to do something about it. And those articles said things like, Black entrepreneurs are over-mentored and underfunded. And, there's a lot of talk going on. So Irv says we have to do something. So within a day, we came up with this plan to launch the Seedfunders Opportunity Fund. And when we looked at our system, and there was all this talk of this systemic racism, and we're thinking, well, we don't do that. We don't judge anybody based on, other than the submittal. Well, what we found was, when thinking about it, these even though we invest that early, we do require an MVP. So a company has to have an MVP and a website and a pitch deck and things. That takes money. Yep. And that is typically what's funded by the friends and family around. Well, when we looked at things, we don't see a lot of Black entrepreneurs applying because they don't have that friends and family around to even get an MVP, to even get the MVP or get a website or get something to show us. So we decided to launch this fund, and basically the goal of the fund is to provide that friends and family around to the Black entrepreneurs. So the first $25,000 or $50,000 to get an MVP, so then we could look at it as a company. We have something to look at to judge whether to do follow-on funding. So the whole goal of the fund is Black Entrepreneurs Matter is our tagline. We want to find these Black entrepreneurs that have a good idea that we can help get launched and get the company moving and get the first friends and family around. We want to be the friends and family.
Yeah, and you know how much I love that whole thing. It just really is evening the playing field. It's not giving them a hand up or anything. It's just putting them in the same level as everyone else. But for the rest of you, have you done any efforts to diversify your portfolios or help minority entrepreneurs or minority-owned companies?
Let me take that question. I would, first of all, I want to say kudos to Dave to really go where it needs to go. So for us, we thought about this question from the diversity question, right? You know, a while ago it was, you know, where are the women in the pipeline? And then now currently it's where are the Black entrepreneurs in the pipeline? And it always comes back down to, if there's nothing at the top of the funnel, then it's tough to squeeze anything out of the bottom of the funnel, which is an invested case, right? And top of the funnel, to that end, what we have been doing is we definitely make a point to try to identify and go to a lot of these diversity specific pitch events, and in hopes of finding them. But you know, like Dave's identified, if they haven't gotten to that through that first hurdle, they're unlikely to show up on the top of the funnel. And so that's where we're focusing a lot of our energy, is like, where can we go to broaden our top of the funnel? And this goes beyond just the established pitch events or whatnot, because by the time people get there, they likely have already gotten some benefit of what Dave is talking about. It really is also about broadening personal networks. You know, a lot of our deals did come to us because we know people, but if nobody you know is in the target group, then you won't get them coming into your funnel. So that's where a lot of our focus is on.
Good points. Saxon, I saw you nodding your head a lot.
Yeah, I just am completely in line with these two, and really Ryan Whittemore had the idea when everything was happening with the George Floyd incident, that we wanted to do something similar to Dave, in the sense of we wanted to spin up our own minority fund. And really, after doing some research and understanding, we came up with the same analysis that both Dave and Coffey alluded to. It's a sort of top of the funnel issue. And Candice Rizvanian, who runs our operating partner program at Florida Funders, she was the one that really brought this to light for me. And after doing some research, that's really what it comes down to. It's getting the resources into the community early on, so that the top of the funnel is a much more even playing field. And that's really where we see the opportunity. So we're working on some initiatives similar to Dave, not a direct fund, but trying to get more involved from that side of everything earlier on with these entrepreneurs inside of these minority communities.
Yeah, it really is so much more nuanced than just saying we need to find more Black funders. It's making sure you expand your social circle so you even know they exist, and making sure they have the money, and making sure, you know, they have the opportunities in their communities that they're in currently. Oh, we lost Dave. So hopefully he'll come back soon. But yeah, no, I think what you guys are doing is great. Barry, do you have anything to add to this conversation?
No, not really. I mean, it's, you know, we don't help companies get started. So, you know, our profile is very much a financial profile, not a profile of who the owner is for the companies that we're helping.
Okay, perfect. Now to my favorite part, everyone else's questions who they have submitted. So we'll start with those. And then for anyone who's watching right now, if you do have a question, don't forget to submit it to the question box. Then we'll put it right up here and ask away. So the first question says, glad to hear that investors have remained engaged and active. Curious to see how the deal flow has been from prospective companies. So if anyone wants, I'll put this in the chat as well so you guys can read it, but anyone want to take?
Deal flow for us is strong. I mean, this isn't something that I'm directly involved with, but from what Ryan and his team tell me, we're still seeing a lot of deal flow coming in. We're still actively going out there and pursuing deals. One of our sort of new strategies is, and it's not a new strategy, but really what we're focusing on is going after verticals that we really want to be in. And instead of having an inbound type strategy, we are now going out and really focusing on several verticals and having an outbound strategy, looking all around the country for companies that we want them to have a Florida presence and we want to be in these types of industries. So for us, we haven't seen a slowdown in terms of deal flow by any means.
Good. Kathy, same with you? Good, solid to hear. How has COVID changed your investment criteria in terms of employee demand, touchless solutions, SaaS versus retail, and other variables? I know we touched a little bit about that, but I think they kind of want the more nitty-gritty things.
So in terms of our criteria, as we discussed earlier, there is a very strong, level of energy put into understanding really what is the funding getting you to. Because, before you might have thought, oh, well, this doesn't work after you pivot and get a couple of milestones, you could maybe raise again. And now there's just so much uncertainty around that you really have to have your act together and truly understand what you're running towards.
Yeah, I agree with Kathy on that one. I mean, we love software, we love B2B, we love enterprise. I mean, that has not changed once again, just based off the public markets. I mean, these valuations of some of these companies have just skyrocketed, and we sort of continue to see that is going to happen. We probably don't want to play anything, not that we ever would, but direct retail locations. That's not something we would do in the past, but probably not something that we're really interested in. Hospitality is something else that we're not scared of, in the sense of we wouldn't invest in traditional hospitality, but with what is happening right now in the market, there's going to be so much opportunity inside of hospitality, but it's going to be new age hospitality. It's going to be different things that we're not even thinking about today, that we're going to see some amazing ideas, some amazing business plans around, and some great companies coming out of this, just like we did in 08, 09. Some of the best companies today were built out of the adversity then. And we just look at this as another massive opportunity. But a few of the places that we are looking, I already mentioned this, ed tech, you have telehealth and healthcare tech. We think that there is significant opportunity inside of those two industries. And we're just going to stay opportunistic around really anything that has to do with those industries, I would say.
Great. Barry, we have a question for you, and I'll ping it to you right now. I'm curious to know from Barry whether investment bankers working on raises and M&A transactions are seeking to increase their success fees to account for challenges brought on by COVID and economic concerns.
No, I haven't. I'm definitely don't see that happening. But it's, I mean, look, when we take on an engagement, we want to have a high degree of confidence that there's going to be, that we're going to be successful with it. So that's the main criteria. So I don't think that there's an increased fee because of the macro environment. That's I have not seen that, no.
Okay. Saxon and Kathy, you both were smiling during that question. Do you have anything to add to it?
I hope Barry's fees don't go up. No, I mean, we're obviously on the equity side of everything, so that hasn't been something that has come up with us. Although we have seen some nice movement in the M&A market with some of our portfolio companies, so that's been exciting.
Yeah, for sure.
I would say that general price increases has not been a successful strategy the past 2 or 3 months. But the funny thing is customer acquisition cost has gone down for some of the companies that we're looking at, because all of a sudden there's the opportunity to say, try us out since you're stuck at home. So for a lot of software company, we're seeing customer acquisition goes down. Now, obviously, once you acquire them, whether or not you can get them to renew and actually move to the pay model, that's the challenge. And we haven't seen evidence of that being, one way or another.
Great. And one more question. Oh. What key elements does Florida need to better develop its startup ecosystem? And this is more toward Saxon and Kathy.
Yeah, this is something that we at Florida Funders sort of live, breathe, sleep, eat, is how to really make this ecosystem on the same level as a Silicon Valley, a New York City, a Philadelphia, Pittsburgh, those types of cities. And really, we believe that we're there. I mean, we really, as the state of Florida right now, have made so much significant progress over the last 5 years in terms of resources. We have a 500 startups in Miami. We've got, so many different incubators and accelerators. Our universities are firing on all cylinders.
Yeah.
Florida Poly, we just have a great relationship with them over there, and they're producing some amazing talent, which is something that the state of Florida, from an engineering perspective, did not really have beyond the University of Florida. So we're super excited about that. And then the other thing, and this directly affects everybody that's involved, is there are more people moving down to Florida than ever before, and coronavirus, COVID-19, has only expedited that process. So there's going to be more access to capital. There's going to be more founders moving their companies to the state of Florida because of the warm, literally and figuratively, business climate that we have here. And so you have a lot of individuals that were successful investors in New York and Boston, and they were a part of angel groups, and they were a part of early stage venture. They're coming down to Florida, and it's no longer they're coming down for a few weeks in the winter, but they're down here full time now. And they want that same group. They want that same feeling. And we believe that we provide a lot of that. And so does everybody else here on the panel. So we believe Florida is at the precipice of literally becoming one of the biggest technology drivers in the country. And then also to back that up is just the unicorns that we've had in the state over the last 5 years. I mean, just in our backyard here with ConnectWise, absolutely amazing, creating, I think it was 70 new millionaires. Well, what do you think those guys are going to do and those girls are going to do? They're going to go and they're going to start new businesses, and they're going to continue to fuel that economy in terms of this organic innovation startup ecosystem.
Kathy, I'm going to spin it a little from you. I know that you're obviously in Orlando. What is Orlando doing well that Tampa Bay needs to do? Not to put you on the spot.
I think, and I'll answer that question a little bit differently, in terms of what each of these markets are doing differently. I would say that 5 years ago, when I look at the ecosystem, Florida is really more like 10 different ecosystems, very tiny ecosystems. When you added them all up, they've got as much resources and assets as, say, like a Bay Area. But you have to add them all up, and they're not to be added up, because you look at our geography. Florida is this Swiss cheese, right? We've got lakes and sinkholes everywhere, and you couldn't even fly to one place to another. You got to drive 3 hours to go to a different city. Yep. So in that respect, it was, all the elements are there. They just aren't touching for some reason. But through, the efforts of a lot of people, and this is, Saxon and Barry and Dave and folks like this, we've now gotten to the point where it's really rare for me to see a deal, say from Miami, where only the Miami folks know about it. Used to be even two sides of town, they'll have two different angel groups, and their deal flow will be different. But that is now a very rare thing. So in 5 years, you really do see a different world. So I agree with Saxon's optimism in that Florida really has done a lot of building in the past 5 years, and probably building on top of the past 10 years before that. But I would say, though, that when you look at a deal that is bred and brought up here compared to, say, a deal that's out in, say, Silicon Valley, and I'm not saying they're actually better. I would still say that our deals in this ecosystem still tend to be, and it's a good thing and a bad thing, it's very capital efficient. That's a good thing. But it's still a little kind of a poor man's child in that in Bay Area, you'll see a lot more deals where they just throw a whole bunch of money at it. And maybe it's not the smartest way to go about doing things, but you throw enough money at it, you'll eventually, poof, a unicorn popped out. Here, I think we still don't see as much luxury in terms of flushed capital. Now, I'm not saying we should ever get to flush capital. It's a bad thing to be wasteful, but I think we can use a little more. I do think we can.
And I think it's you can't under appreciate what they've done at Florida Funders. I mean, now being recognized nationally for your activity what you guys have done has really been fantastic. And Saxon, to your point, the ConnectWise story is a great story, and don't overlook KnowBe4 as well. I mean, another great local company that's now has that unicorn status, that led by a guy who does reinvest in the community. That's not his first company, right? I mean, he was the founder of Sunbelt Software before that. Stu's an interesting guy. So and to your point, with folks moving to town, the house next door to me is a rental, and it's a guy that just moved his whole family here from Chicago. He's like, I'm like, what are you doing? He's like, I'm here for 2 months. I'm buying a house. I'm moving down here. I mean, that's a real trend. I mean, it's there's a lot of New York plates driving around here right now, and Illinois plates. So I do think that is another tailwind. But to all of your points, the startup ecosystem today looks a hell of a lot more mature than it did 5 or 7 years ago. And that's a testament to a lot of the work that you guys have done. So thanks for that.
Yeah, Dave, good to have you back.
I actually had a power outage for a minute and everything blinked, and then the router took a while to reboot. But it sounds like we're talking about the ecosystem and the changes. When I started Florida Funders 8 years ago, it took me about 12 investors to get $80,000 together to make our first investment. 12 or 15 investors to get $80,000. And they said, you're investing in technology, startups? What? Why didn't they go to a bank? Just get some money at a bank? Literally, they would say, why don't they go to a bank and get a loan? And that was just 8 years ago. So it has changed dramatically. And as Barry said, thanks to Saxon and Mark and Tom taking Florida Funders to that next level and getting national recognition, it's just really been incredible for the whole state.
Definitely. Well, I think it's a great note to end on. But thank you guys so much for being here today. I think we covered a lot of information that hopefully people can take away and go implement in their own companies. And thank you again to our sponsors, University of Tampa, OmniPublic, and Synapse. Could not have done it without you, but check for the recap tomorrow at tampabayinno.com. And this video will also be on YouTube if anyone wants to go back and take more notes or share it with someone who they think they would benefit from. So feel free to look for that as well. But thank you guys very much and have a great rest of your day.
Thank you, everyone. Really appreciate it.
Thanks,
Have a great week.
Thanks, everyone.
Thanks.